and that's prepping for the big holiday stock shopping spree.
Right.
Question is, why? Why are we buying these stocks now? And has this shopping spree started? And if so, what stocks are you looking to buy?
Right. So it's nearly impossible to predict a stock market bottom. But what we do know from history is that every bear market eventually ends and turns into a bull market. That's just the cycle of finance, the cycle of Wall Street, the cycle of financial markets. Everything in life, Aaron, really is a cycle. The sun rises every morning, it sets every night. The seasons, spring, summer, fall, winter, spring, summer, fall, winter. You get up, you eat breakfast, brush your teeth. Maybe you brush your teeth and eat breakfast. I brush my teeth before I eat my breakfast. But anyway, that's beside the point. You go to work, you work all day, you come home, you have dinner, you enjoy some family time, and then you go to sleep and you do it all again the next day. Everything in life is a cycle. And the markets are no different, that we oscillate between bear markets and bull markets. We go into a bear market for 1 to 2 years, and then we bottom and we go into a bull market for 5 to 7, sometimes upwards of 10 years. So that's the cycle of markets. So what we do know from history is that every bear market ends. Every stock market crash turns into a stock market rally. This time is going to be no different. This is not a world ender. So let's start with that basis. So what we can do in a time like this is say, okay, we're 30% down. We're 12 months in, we're 11 months in, and that kind of puts us right around average bear market length and drop. The median bear market decline since 1929 is about 29%, I believe, and the median time is 12 months. So down 29% over 12 months is your median bear market. We're down 30% over 11 months, so we're right there. So what we can do is we can say, okay, we got this historical context. Now let's look for bottoming signals. Let's look for signs that the market is working towards a bottom, getting close to a bottom, or has maybe even bottomed already. And when we look at those signs, we're seeing a lot of positive signals that the stock market is either at a bottom, has already bottomed, or very close to a bottom in terms of price and time. Now, when you look at valuations, that's a really important one. We dropped to, at the low, we were around 15.5 times forward earnings. Over the past 3 decades, stock market crashes have typically bottomed around 15 times forward earnings. The exception, of course, was the great financial crisis of 2008. We do not have that today. Stocks dropped all the way to about 11 times forward earnings then. And that's because confidence in the economy was literally zero. We're not there today. So we are, stocks bottomed in 2020 around 14 to 15 times forward earnings. They bottomed in 2018 around 14 to 15 times forward earnings. They bottomed in 2002 after the dot-com crash around 15 times forward earnings. So that level is kind of the level at which stocks tend to bottom absent a massive economic disaster. So we're there today. So check on the valuations. What about the technicals? Well, the S&P 500 has collapsed to its 200-week moving average, not 200-day moving average, 200-week moving average. And if you pull up a chart of the S&P 500 next to its 200-week moving average, you will see that 200-week moving average has time and time again over the past 70 years served as a very solid line of support for the market. Almost every bear market, with a very few exceptions, almost every bear market of the past 70 years has bottomed either at or right around the 200-week moving average. So, obviously, again, 08 was an exception, massive economic disaster. So there are certain exceptions, but most bear markets do tend to bottom right around that 200-week moving average. We're there today. We ran into the 200-week moving average, and we're holding support at that level. So the technicals look pretty good. Check that box. Also on the technical front, we have the relative strength index dropped into oversold territory. That's pretty rare for the S&P 500, and usually it marks a local stock market bottom followed by a big rally. Market breadth at the low, around 12% or 13% of stocks, New York Stock Exchange stocks or stocks on the NYSE, were trading above their 200-day moving average. So 85% of stocks were trading below the 200-day moving average. That's the panic zone. We call the panic zone less than 20%. Stock markets tend to bottom when the number of NYSE stocks trading above their 200-day moving average drops below 20%. We dropped into that level. We look at the VIX, the volatility index. Stock markets tend to bottom when the VIX pops into that 34 to 45 range. We popped into that 34 range into that range last week. We popped above 35 for the first time in this cycle. So across a lot of metrics, you're seeing bottoming signs emerge. Investor sentiment, American Association of Individual Investors, AAII, they send out a weekly survey to individual investors, retail investors, asking them, are you bullish? Are you bearish? Are you neutral? How are you feeling about the stock market over the next 12 months? The number of bears in that survey has climbed to near all-time highs. The last time that survey was that bearish was March 9th, 2009, the very week after the stock market bottomed. Stock market bottomed on March 6th, 2009, a Friday. So that next week, the sentiment hit all-time lows, bearish sentiment hit all-time highs. And that's where we are today. The other reading was back in the early 1990s, right around the bottom of that bear market. So sentiment is as dour as it is when stock markets normally bottom. So there's another thing. Cash positioning. Bank of America's Equity Fund Manager Survey. They go out, they survey a bunch of fund managers. What levels of cash are you sitting on? Cash levels today have hit record highs, higher than '08 even, higher than '07, '08, '09, and as high as they were back in the depths of the dot-com crash. So that's another contrarian buying signal. Short positioning, the put-call ratio is above 1. Stock markets tend to form local bottoms when the put-call ratio goes above 1. The percentage of firms, hedge funds, smart money institutions that are short the market is also soaring. I don't have exact data on that, but a bunch of surveys, RBC surveys, the most recent one, comes out and shows how bearish these hedge funds are. That also is another contrarian buying signal. So when we look across all of these metrics, and literally I just rattled off, it seemed like a ton of them, but what we have on our radar is a bunch more, dozens of these metrics across valuation, across earnings, across technicals, across sentiment, across positioning, across all of these things that all of these indicators are flashing, saying we are either very close to or already at a stock market bottom. Now, all of these indicators could be completely worthless if a black swan risk emerges, right? That's the big risk today, some black swan event. Now, for context, a black swan event is an unforeseen, massive economic event that happens that throws everything off course. In 2008, that was Lehman Brothers. A lot of people don't know this, but the bear market of '08 would have ended in about September of '08 had it not been for Lehman Brothers. And then the Lehman Brothers bankruptcy happened, and that just threw a whole wrench in the situation, and the financial contagion started, and boom, we dropped like a rock. So there is definitely potential for a black swan risk. And if we get that black swan risk, stocks will continue to crash, and we will take a very big leg lower. But that's always a risk. That's always a risk. I think the risk of that happening, the probability of that happening is very low. Credit Suisse, there are rumors they're on the brink. Deutsche Bank, there are rumors they're on the brink. But since then, European and British markets have calmed down. So whatever brink they were on, they've walked back from that a little bit. Not to mention, those banks don't have much, from my understanding, risk relation to the major U.S. banks, the Bank of America's, J.P. Morgan's, Goldman Sachs, all of whom just reported earnings and all of whom sounded a pretty optimistic tone. They're pessimistic about the economy, but they're optimistic about their standing, about their cash positioning, about their leverage, about their lack of risk exposure to a financial contagion. So I don't think we have another Lehman moment in the works right now. Absent a Lehman moment, every indicator out there is saying we're close to a stock market bottom. Valuations, earnings, 200-week moving average, sentiment, positioning data, whatever you call it, whatever you want to, go down the list, all the check boxes are being checked. And that's why we're getting increasingly bullish on the stock market right now. We think, we've been calling for a long time a grand finale sell-off, a grand finale sell-off, a grand finale sell-off. And I think we got that grand finale sell-off. And it kind of crescendoed last Thursday after we got the really hot CPI print. We got that really hot September CPI print. and stocks opened up massively lower. The NASDAQ was down more than 3% at one point. It closed the day up more than 2%, 5% swing. We think that morning sell-off, that 3% drawdown, was the crescendo of selling pressure, of capitulation, of panic in the markets. And therefore, we're now ready to move higher. Interestingly enough, we ran the analysis on it, and I actually have it up right here. I pulled up an Excel spreadsheet and went through all the instances and wrote them down of when stocks opened up lower and finished higher, and that swing was greater than 5 points in magnitude, so 5 percentage point bullish intraday swing. Whenever we had that in the midst of a bear market, and I wrote down all the times we had that, there were 20 counts of it since 1970. So the past 50 years, it's happened 20 times. And 19 of those 20 times, stocks were higher a year later. The only time they weren't was in the midst of the great financial crisis, of the Lehman moment. So again, another data point showing that a Lehman moment could throw everything off. But if we don't get a Lehman moment, absent a Lehman moment, stocks are going to be higher in 12 months. We are at least 12-month investors. We invest for at least 12 months and oftentimes longer. So on that premise, could stocks go lower over the next 1, 2, 3 months? Absolutely. But we're very confident saying stocks from October 2022 to October 2023 are going to be significantly higher. They're going to move a lot higher. So we're buying today because we're confident in that 12-month outlook.
Thanks for watching HGI Clips. For the full episode, head on over to our sister channel at Hypergrowth Investing by clicking the link in the description, or listen to the podcast on any of your favorite streaming platforms. We make new episodes every Wednesday, so make sure to check it out and subscribe to never miss any of Luke's Hypergrowth insights.